Welcome to the Deep Dive. Today, we're plunging into the second quarter 2025 results for Riskified, the AI-powered fraud prevention platform. We've got quite a bit to unpack here, especially why the market reacted so cautiously despite some seemingly solid numbers.
That's exactly right. Our mission today is, to cut through the noise, understand their headline financials, the strategic chess moves they're making in this, rapidly evolving e-commerce landscape, and figure out what management is really signaling for the rest of the year and beyond. We'll explore the deeper implications.
All right, let's kick things off with the top-level numbers and then, get into why the market seemed to just shrug.
Yeah.
Riskified reported Q2 2025 revenue of $81.06 million. That's a 3% increase year over year, which, interestingly, actually nudged past analyst expectations. They were looking for around $80.4 million.
Right.
Now, the non-GAAP EPS, which typically strips out one-time or non-cash charges to give a clearer picture of operational profitability, that came in at $0.02, right in line with consensus.
Mm-hmm.
But, and this is important to note, they also reported a GAAP EPS loss of -7 cents. That's the standard accounting bottom line, reflecting all expenses.
And what's particularly striking here is a continued operational discipline. I mean, this marks their 7th consecutive quarter of positive adjusted EBITDA.
7th. Wow.
Yeah, hitting $2.1 million this quarter. That's a 3% margin, so it shows they're making money from their core business. They also generated a healthy $5.3 million in free cash flow, which is up from $4.1 million last year. That indicates they're efficiently turning revenue into actual cash.
Which is always good to see.
Always. Plus, they're sitting on a rock-solid balance sheet. We're talking nearly $340 million in cash and investments and absolutely zero debt.
Zero debt. That gives them huge flexibility.
Incredible flexibility. A huge strategic advantage.
Yeah.
And gross merchandise volume, or GMV, for the quarter also saw a 4% year-over-year increase, reaching $36.4 billion.
Okay, so on paper, lots of green lights, like you said. Revenue beat, decent profitability metrics, strong cash flow, great balance sheet.
Exactly. Yet the immediate market sentiment following the release was, shall we say, quite reserved?
Reserved is putting it mildly. Shares dipped significantly, right? Closing the day down almost 16%.
Almost 16%, yeah, despite that revenue beat.
So with that beat, consistent profitability, pristine balance sheet, why the market's cold shoulder, that really is the core question we need to tackle today. It seems investors are picking apart the nuances, and we're going to pull on those threads. We'll look at everything from subtle shifts in gross margins to where Riskified is placing its big strategic bets, just to truly understand that cautious reaction.
And what's fascinating here is the nuanced story behind the numbers. Let's make you start with their gross margin. That's often a key indicator of the profitability of their core services.
Okay.
So the non-GAAP gross margin for Q2 was 50%. That's a slight dip from 53% last year. It was pretty much consistent with Q1.
Okay, 50%. Why the dip from last year?
Well, management attributed this primarily to the ramping up of new merchants in emerging categories. Think money transfer and payments, and also expansion into new geographies, like the other Americas region that's Canada and Latin America.
So this margin dip isn't just a cost. It sounds more like a calculated strategic investment. Is Riskified essentially like buying future market share here?
Precisely. That's a good way to put it. They're absorbing some initial model training costs now, betting that the data they gather from these new, often higher risk areas will significantly strengthen their AI over time. And that eventually should translate into higher margin, sticky revenue streams later on. It's really a crucial move to diversify beyond their established, maybe more saturated e-commerce segments.
Right. And are they expecting it to improve soon?
They are. They anticipate this margin will improve. They guided Q3 to be slightly below 52%, but then Q4 projected to be higher than 52%. The M is for an annual non-GAAP gross profit margin of approximately 52% for the full year 2025.
Okay, that's management's projection. But, given the market's cautious reaction, what are the key risks? What could stop them from hitting those margin improvement targets, especially if they keep investing in these new, potentially lower margin areas?
That's a sharp question. I think the primary risk lies in the pace of model adaptation and how quickly these new clients ramp up. If the data from these new categories takes longer than expected to yield significant AI improvements, or, if scaling these new merchants proves more costly or slower than they anticipate,
then those targets get tougher.
Exactly. Those Q3 and Q4 targets could be challenging. The market's clearly looking for proof, for evidence that this strategic investment quickly translates to profitable scale.
Fair enough. So, okay, they're managing the margins with an eye on the future. What about operating expenses? Are they keeping costs in check?
Oh, yes. On the expense side, they maintain tight control. Non-GAAP operating expenses were $38.22 million, actually down from $39.3 million in the prior year.
Down, even with inflation.
Down. It demonstrates continued operational discipline. They're really tight on managing their day-to-day costs, making sure every dollar spent is working hard. OPEX as a percentage of revenue actually declined year over year, from 50% down to 47%. That shows they're gaining leverage in their business model. Basically, revenue is growing faster than expenses.
Good sign.
Very good sign. And they're projecting these expenses to remain pretty steady, around $38.5 million quarterly for the back half of the year.
Okay, so that fiscal prudence supports how they use their cash, which brings us to their capital allocation strategy, right? They've got that big cash pile.
Exactly. And they're putting it to work. The board authorized an additional $75 million for share repurchases.
Wow, another $75 million.
Yep. That brings their total outstanding authorization to about $85 million. And they've already been active. They bought back 9 million shares for $44 million just in the first half of 2025.
So management clearly thinks the stock is cheap.
It certainly signals strong confidence in their fundamentals, yeah, and a clear commitment to delivering shareholder value.
Okay, so moving beyond the immediate figures and their disciplined spending, where are they actually finding growth and how are they innovating? Because this fraud landscape, especially with new tech, it certainly isn't getting any simpler.
No, it isn't.
Yeah.
And if we connect this to the bigger picture, their diversification strategy is absolutely crucial, both in terms of categories and geographies. Money transfer and payments was a real standout. It showed approximately 90% year-over-year growth.
90%, mostly new business.
Largely driven by new merchant activity, yes.
Yeah.
Tickets and travel grew a solid 15% year-over-year, and fashion and luxury saw 10% growth. However, management did caution they expect some moderation in the second half for tickets and fashion.
Why is that?
Mainly tougher comparable periods from last year, and also ongoing same-store sales pressure, particularly in high-end fashion and sneakers. Maybe everyone bought their luxury goods already.
Right, trying to beat last year's post-pandemic travel surge or something. Makes sense. And are they seeing this growth globally? Are they making significant inroads outside the U.S.?
Absolutely. International growth was not just strong, it was strategic. Get this. 7 of their top 10 new logos in Q2 came from outside the U.S.
Oh, interesting. So the focus is shifting internationally.
It seems that way, or at least balancing out. They're seeing robust double-digit growth across the board internationally. APAC jumped approximately 40% year over year. Other Americas, Canada and Latin America up 16%, mostly from new business momentum. And EEA showed 23% growth, concentrated in fashion, travel, and money transfer.
And all that helped offset the U.S.
It did. This robust international performance helped offset an 11% decline in the United States. That U.S. decline was mainly driven by a really significant 74% contraction in the home category.
74%. Ouch. Maybe everyone just finished their pandemic-fueled home improvement projects and paused on buying new couches for a bit.
Could be. Seems plausible.
Okay, you mentioned innovation. You highlighted agentic commerce earlier as a critical new frontier. That term itself sounds like something from, I don't know, a futuristic thriller. Can you unpack for us what agentic commerce truly means? And more importantly, how is Riskified specifically positioning its AI to confront fraud in this new landscape?
Yeah, it does sound a bit sci-fi, doesn't it? But it's becoming very real. Imagine an AI assistant, like a chatbot or something more advanced. But instead of just recommending products, it's autonomously browsing, comparing prices across different sites, and actually completing purchases for you.
Okay, so AI doing the shopping.
Exactly. AI performing transactions on behalf of users. But here's the kicker. If legitimate AI agents can shop, so can malicious ones. Bad bots on steroids, basically.
Ah, right. That changes the game entirely.
It really shifts the fraud landscape. You move from trying to detect human-like patterns to fighting hyper-efficient AI-driven attacks. They can use stolen credentials or exploit vulnerabilities at a scale and speed a human fraudster could never dream of achieving.
So Riskified's focus here is what? Blocking these new superbots.
It's more than just blocking bots. It's about future-proofing their entire platform. They're building a defense mechanism for an era where fraud isn't just automated, but truly intelligent and constantly adapting. They're trying to get ahead of it before most traditional fraud systems even recognize the threat. They've already launched multiple solutions and tools to address fraud and abuse in this specific area.
Helping merchants tell the good AI shoppers from the bad ones.
Basically, yeah. Identify legitimate AI shoppers while blocking these sophisticated AI-driven threats. It positions them as a vanguard in what's going to quickly become a critical battleground. And a key part of this strategy is their new partnership with Human Security.
Human Security, what do they bring to the table?
They specialize in AI agent visibility and governance. So they're combining humans' ability to see these AI agents with Riskified's deep e-commerce risk intelligence.
Makes sense. Two sides of the coin.
Exactly. And Riskified noted that this agentic traffic volume they're seeing currently shows approximately 2 times higher risk traffic than normal human traffic.
Double the risk. Wow. Often driven by stolen credit cards, I assume.
That's what they indicated, yeah. Stolen cards being loaded into these AI agents. So this collaboration aims to set the standard for safe and profitable agentic commerce growth.
So they're really leaning into the future of e-commerce, anticipating that next wave of challenges. What about other product enhancements? Are they shoring up their current offerings too?
Definitely. Beyond agentic commerce, they also highlighted increased adoption of their Policy Protect product. That helps merchants manage and prevent policy abuse. Think refund fraud, promotion abuse, that sort of thing.
Stuff that costs merchants money but isn't direct payment fraud.
Exactly. And they launched a new refund abuse model that improved technical performance by at least 15%, leveraging their big network insights. Their adaptive checkout offering is also gaining traction. It's pretty neat. It optimizes the conversion funnel by sending smart signals to payment processors to boost authorization rates.
So fewer good customers getting blocked.
Right. But it also applies intelligent friction, like maybe an SMS verification or a 3D secure challenge, only on those borderline transactions. The goal is approving more legitimate transactions, which is a key enhancement to their core chargeback guarantee.
And are customers sticking around? Renewing contracts?
Seems like it. A strong sign of customer stickiness was their 100% renewal rate for large contracts in Q2.
100%. That's impressive.
Very. And significant upsell activity, too. They mentioned a large ticketing merchant, for example, moved all their transaction volume over to Riskified.
What drove that?
According to Riskified, it was driven by higher approval rates, cost savings, and also the deployment of these policy solutions we just talked about.
Okay, so these innovations and growth strategies are clearly pointing towards the future. Looking ahead then, what's management's roadmap? What's the financial guidance they've provided for the rest of 2025 and beyond?
So they updated their full year 2025 revenue guidance. The new range is $336 million to $346 million.
How does that compare to estimates?
The midpoint, $341 million, is generally in line with FactSet estimates. So no huge surprises there.
What?
Adjusted EBITDA guidance remains unchanged at $18 million to $26 million, with a midpoint of $22 million.
Your cash flow.
They anticipate generating approximately $30 million in positive free cash flow for the full year. They did note the majority of that is expected in Q4.
Okay, back-end loaded and looking further out.
They reiterated they're on track to achieve double-digit revenue growth in 2026. That reflects their confidence in their new business pipeline and these advancing AI capabilities we've discussed.
So they expect a lot of this new business activity to convert later this year.
Seems so. They expect most second half new business activity to convert in Q4, leading to that strong finish and setting them up for 2026.
Okay, so let's bring it all together. What does this all mean for you, whether you're an investor watching the space or just someone tracking the evolution of e-commerce and fraud? We've got a company with, solid profitability, a strong balance sheet, a clear vision for tackling emerging fraud, yet the market reacted with distinct caution.
It really raises that important question. Why the divergence? The market appears to have focused intently on the modest top-line growth, that 3% year-over-year revenue increase, and the short-term gross margin compression.
The investment phase stuff.
Right, driven by investment in new categories and geographies, along with that gap loss. And this seems to have overshadowed management's emphasis on strong operational execution, expanding the product breadth beyond just chargeback guarantees and that expanded share buyback program.
So investors want proof sooner rather than later.
It seems that way. Investors are looking for clearer proof that the growth from these newer, faster-growing categories will translate into improved top-line growth and margin expansion, and maybe faster than management is currently projecting. So for investors, the key catalysts to watch in the second half of 2025 really include: 1, continued activity from that expanded share repurchase program. That provides a kind of fundamental floor.
Okay.
2, traction from their new agentic commerce solutions. And that human security partnership, can they really capture this evolving market? 3, the usual seasonal uplift from holiday e-commerce activity. That could boost transaction volumes.
Always a big factor.
And crucially, 4, execution against their full-year guidance, particularly delivering on their promise of improved gross margins in the second half, with Q4 targeting above that 52% mark. If they can demonstrate that these newer, faster-growing categories start to stabilize and actually improve their margins, well, that could significantly re-rate the stock, especially considering their strong cash position and zero debt.
Makes sense. Okay, now for our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea, like a hedge fund analyst trying to convince the investment committee.
All right, let's get speculative. Given Riskified's robust balance sheet, remember that $339 million in cash, no debt, and that significant post-earnings price drop. An interesting thesis emerges. We know the market reacted negatively to the short-term margin squeeze and the modest growth figures, but the Axuti, the company, is actively repurchasing shares, signaling deep conviction in its own value.
Right.
And it's positioning itself right at the forefront of this agentic commerce fraud wave, which is a critical and evolving threat. So my idea, long RSKD via a long-dated call option strategy.
Okay, long calls. Tell us the specific play.
The play would be to consider buying out-of-the-money call options. Think maybe 12 to 18 months out for expiration.
Giving it time to play out.
Exactly. The current valuation, especially after that post-earnings dip, presents what could be a compelling entry point for a potential rebound, using options for leverage.
And the rationale. Why this specific bet? What needs to happen for it to work?
You're essentially betting on a few key things happening. 1, management executes on their guidance, especially that improved gross margin in the second half. 2, you see significant traction from their new agentic commerce offerings, maybe some big client wins announced there. 3, the strategic value of the human security partnership becomes more apparent, maybe setting an industry standard.
Okay.
Plus, that expanded share repurchase program provides a fundamental floor and acts as a catalyst for EPS accretion, basically boosting earnings per share for the remaining shareholders by reducing the share count. So this trade acknowledges the current market skepticism, yes, but it leans into the company's strong financial health and its strategic positioning for that 2026 double-digit revenue growth target they mentioned.
So you're leveraging the market's short-term focus to capture potential long-term upside.
That's the idea, betting on the long game in a company that's actively innovating in a critical, evolving space.
All right. That wraps up our deep dive into Riskified's Q2 2025 earnings. Definitely a quarter of mixed signals. You had the revenue beat, strong operational profitability, but a market clearly hungry for faster growth and quicker margin expansion.
Absolutely. The key themes to watch going forward will be their ability to scale those new categories while improving the gross margins. That's crucial. And also how effectively they capitalize on this burgeoning agentic commerce opportunity, especially given the increased risk traffic they're already seeing there. This will be the true test of those strategic investments they're making.
So stepping back, what does this all mean for the future of online commerce? I mean, the increasing sophistication of e-commerce fraud, especially with the rise of these AI-powered agents, it presents both a massive challenge and, frankly, a massive growing opportunity for companies like Riskified. How will this redefine the very nature of trust and security in online transactions? And what new solutions will emerge as AI continues to shape our digital lives? It definitely makes you wonder if our digital wallets are truly ever safe. Something to chew on.
And just to reiterate, remember, this is not financial advice. You should always do your own due diligence before making any investment decisions.
Absolutely. We encourage you to continue exploring these topics. Thanks for tuning in to The Deep Dive.